James O'Reilly here from Northeast Wealth to give you your summer 2025 economic update. As always, general advice disclaimer, I will leave you to look at that in your own time. Let's jump into the meaty stuff. Firstly, talking about the global equities markets. This year has been a very, very interesting one in the sense that it's been very hard to allocate capital. There has been a really significant level of variance in terms of the different indexes, different global markets, different regional markets, and the performance that they've had. There's been a number of reasons for that. Economically speaking, we've seen, although broadly we've seen an interest rate easing cycle around the world. That has happened at differing points for each economy, which has resulted in different upticks of return and different expectations throughout the market. But in addition to that, there have been a couple of primary drivers that have really pushed equities markets. One of the big ones, of course, has been the adoption and the development of AI, and that has affected different economies differently in the sense that some economies have a high level of exposure to that, or to say it differently, their equities markets do, such as, for example, the US market. And there are other markets, for example, ours, the Australian market, that really has very little investment exposure to AI relative to the overall index. Overall, what you can see is that we have had positive years across the board. The 5-year laggard here, of course, has been emerging markets. But having said that, they're starting to things are really picking up there, which is pleasing. We are, however, getting to a point in this cycle where we're starting to look at things and carry a genuine concern that perhaps we're becoming overvalued. So let's speak to that now. What you're looking at here is the S&P 500, which is the US, for simplicity, a good proxy for the US market. And you're looking at what's called a Shiller PE ratio. Many of you will be familiar with the term PE ratio, and of course that stands for the ratio of price to earnings. So for simplicity, if you had a company that was earning $1 million a year and it was available for sale at $10 million, or all of its shares were priced in such a way that it had a $10 million valuation, that company would have a PE of 10. In this case, when we use a Shiller PE ratio, it's a little bit more complex because what we're seeking to do is average out the earnings to take into account that earnings are cyclical. You can have periods where a business will have very strong earnings and then very weak earnings depending on the different nature of the different natures of the business. So what this does is it takes a 10-year earnings profile and then inflation adjusts it, but then averages it out to say, well, where are we here? We don't want to flash in the pan earnings value giving us a really high valuation, or earnings level giving us a high valuation. We want to take an average of where is this company going over the long term in terms of its earnings. And for that reason, the Shiller PE ratio can be a really good one when evaluating long-term share market pricing and whether or not it is cheap or it is expensive. Now, if we look at this particular graph, we are going all the way back to 1870, all the way to 2025. So we've got 150 years of data here. And you can see a key thing, which is that very often when this ratio gets too high, the reversion that we see is sharp the other way. And unfortunately, the times when it does revert sharply the other way, there are times that we tend to look back at those times and say, oh yeah, that was terrible. This peak was 1929. We all know, many of us have heard of the crash of 29. We move across to this peak over here, that was 2000. And of course, many of you would recall that this represents the dot-com crash, where we had outrageous exuberance as to the value of companies. We've got companies that are earning $1 million a year, and we're saying we're going to value them at 100 million, because it's not so much about what they earn this year, but with the internet going bananas and everything develop, every single person is going to be on the internet full time as of tomorrow. These companies are going to earn $100 million next year from their 1 million this year. So we saw this crazy hike in valuations. The earnings didn't commensurately increase, and so then when we saw this crash, we saw that revert back. The reason why this is valuable is because, of course, we are looking at the current data point here and saying that is pretty toppy. That's a very, very high historical PE ratio, even over 150 years of data. The long-term average here, if we're thinking about a median, we're probably around about 16 times in that sort of zone. And in our mind's eye, I'm not necessarily looking at this thinking that this is this is the indicator that we're going to have a crash tomorrow. But what it does say is that markets are extremely toppy and they are much more susceptible to very high levels of volatility than normal. This is something that we're watching really closely, and indeed with our own portfolios, we're doing our best to position them in anticipation that we might see more turbulence. We might see a lower focus on growth stocks over the next few years and more focus on just stocks that pay a regular dividend, like your traditional value type stocks. So how can we make sure that the portfolios are adjusted accordingly? Now, the other part of this too is where we go from here. I mean, in order for this PE ratio to reduce back down, or to revert to the mean, to reduce back down to normal levels, there's only a few things that can happen. The first thing is that we can see valuations fall significantly. That's not something that anyone wants to see. The second thing that can happen is that valuations can either stay the same or grow at a really modest clip while earnings grow at a commensurately faster rate. And I suppose that's sort of the Goldilocks effect that we're all hoping for here. Now, the third scenario is that earnings just explode and then the ratios prove to be correct. Historically, that's not happened. When we've looked at the times when this Shiller PE ratio has been very high, we don't see earnings just magically increase to meet the valuation requirements. We see the valuations correct. So hopefully it is the second option, but what that speaks to is the possibility that we may very well need to reset our expectations in terms of what equity markets are going to deliver over the next 5 to 10 years. If we look back to home and talk about inflation and the RBA cash rate, we had a really significant and frankly depressing data point that was released only a few weeks ago. And that was specifically that inflation is at 3.8%. Now, just to give you a little bit of a background here, the black line here is inflation from 2015 through to today. Post-COVID, we saw inflation run rampant all the way up to around, if I recall correctly, 7.8% was the highest data point. And then at this point, the RBA said, okay, inflation's going crazy, so we need to start hiking interest rates, which is this yellow line. And we saw this very, very aggressive interest rate hike to take the cash rate from 0.1% to 4.35%. Now, that worked. Everyone said, whoa, that's very expensive and I don't have money anymore because my mortgage is huge and all those other problems that come with higher cash rates. And so people stopped spending money, inflation curbed, and these numbers fell down into what is considered to be the RBA's target band of between 2 and 3%. As inflation moved down into this target band, the RBA said, okay, great, we're at the bottom end of the target band, so we're going to start reducing interest rates in order to make sure we don't crash through this floor and we stay within this range. No sooner have they started reducing interest rates with these 3 cuts, 1, 2, 3, that Australians have said, you beauty, well, let's get back on the train of spending all the money that we possibly can. And so we've had this big hike from what was around about 2.1% up to 3.8% inflation. This is the reason why we are suddenly having all this commentary to say, well, maybe we actually need to increase rates next rather than to decrease. And the RBA is looking at this saying, maybe, most likely, 3 interest rate cuts was too much. We probably should have done 1 or 2 at most and waited to see what happened. For my own sake and for everyone else's sake that has a mortgage, I hope that the next cash rate data point is something a lot safer than 3.8. Because if it were to go up again, I think that it's a very, very, very high likelihood, almost locked in, that we would see a hike in interest rates. So the next data point is going to be absolutely critical. But if you want to influence it at all, then please do me a favor and yourself a favor and stop spending money. Let's all just rein it in and keep it in our offset accounts and do our level best to keep the cash rate exactly as it is. Let's move on to the domestic property market. What we saw over the last 12 months was, again, a really varied level of growth from all the different capital cities, noting that we've got 5 of the capital cities just here, but a big amount of variation, 4.4% in Melbourne and 13.5% in Perth. It's not uncommon to see variations this wide across property markets, but it does speak to the fact that, firstly, property markets are positive, but where you are in the property market in Australia is having a really big impact right now. Combined capital average was 7.3%. Nice to see Sydney and Melbourne get off the canvas, so to speak, and some of that growth to come. It's been a couple of years since we've seen that. However, also we've noticed that the most recent interest rate news and the likelihood of a potential rate increase has meaningfully impacted the market. We're looking here at weekly clearance rates for auctions across the combined capital cities. As a house rule with auction clearance rates, if you have consistent clearance rates in excess of 70%, you're going to see reasonable property growth there. Above 75% is starting to reflect a very hot market. And if we see clearance rates below 60%, that's reflecting a very cold market. Now, this is from December 2015 to December 2025, so we're talking about 10 years. But the thing I'd like to draw your attention to is this period here. From around about January or February, we saw this increase in clearance rates from around about 55% up to about 70% nationally. And that predominantly was driven because interest rates were coming down. Suddenly people said, okay, I'm now feeling more confident to buy that bigger home, or alternatively to buy the investment property and do those sorts of things. More people entered the market, and as a result, prices climb, but the clearance rates go up, and which is reflective of the fact that more people are buying, which is fueling growth. Now, more recently, we've seen this curve and go back the other way, and one of the primary reasons this has happened is because suddenly the rhetoric is that rates might actually go up again rather than down, and it's resulted in more people keeping their hands in their pockets during the auction and feeling less confident that we're going to have this low interest rate environment again, where the property market is going to keep growing at these magnificent levels, and every property investor is going to be rich. It's going to be very interesting to watch this one unfold. It probably, again, in property sense, even more emphasis on the next data point from the RBA. So in summary, global equity valuations, they do look bloated, especially in the US. That definitely creates some trepidation for how we invest your money, and also being prepared and willing to make changes to portfolios and changes to your strategic asset allocation if we do see markets aggressively start to move the other way. The 5 to 10 year return expectations may need to be adjusted, as I covered off, notwithstanding that we do have the scope to cut rates as needed if we did have that hard fall type scenario that has historically been done by not only the RBA but reserve banks all over the world. December quarter CPI, which is the data point that the RBA most likely is going to rely on, comes out on the 28th of January, and that's going to be a very, very, very important data point for the cash rate. Fingers crossed for all of you. And lastly, from our end, our view is currently we retain strategic asset allocations unchanged. As a house rule, as you all know, we are typically going to try to leave these unchanged most all the time because this is the biggest driver of your portfolio returns. Having said that, as it says here, we are prepared to make adjustments if we are facing a strong sell-off. So this is going to be something that we watch very closely. Thank you, everyone. I really appreciate your time today. And as we're getting so close to the festive season, I'd like to wish all of you a very Merry Christmas, very happy holidays. I hope you have a great time with family and loved ones. And if there's anything at all that you need or that we can help you with, please don't be afraid to get in touch with us. We're very grateful to have been able to serve you for this year and onwards and upwards for a successful 2026.